Sure. I started this fund about 7 years ago. It grew out of a family partnership. I've been managing our family money for 20-something years at this point. And I eventually made that into a business and opened it up to outsiders. Our compound annual return is about 15% right now, since the beginning of this fund. Over my life, it's higher. And we typically we're a concentrated fund. We don't use leverage. We typically have significant amounts of cash. We've had anywhere from, occasionally we're fully invested. Most of the time we have 20 or 30% cash, and we've had as high as 60% cash. We are, because we're concentrated, it's very important that we invest in things where we think over 3 years, if they do well, they can double or triple. But if they do poorly, we'll get our money back. So we pass on lots of great ideas because if the idea is a great idea and it's very likely to double, triple, or better, but there's a chance it goes to zero, we can't take a big position in that kind of idea because we take concentrated positions of 10 or 15% or more of our capital. They need to be ideas that are very safe so that eventually we're confident we'll get our money back, even if there's volatility in the middle. And so that's what we look for, those ideas that are very asymmetric. And we pass up lots of great ideas that other people invest in with smaller amounts of their fund, but that don't fit our strategy well. We look in a few places. So we look in traditional special situation areas like spin-offs, bankruptcies. We used to do more in the bankruptcy world, but up until this year, there have been very few bankruptcies. But I think that'll change. And we also look for companies where there's an event occurring that creates a lot of uncertainty about the near-term earnings, but doesn't impact their long-term economics. So today I spoke about American Express. There are a few things occurring that make it very hard to know what the next 12 months of earnings for American Express are going to be. But it is possible to analyze Amex and know that in the next 3, 5, 10 years, the company will continue to do very well. So for us, that's a very perfect type of investment. There's an event occurring, but the long-term business model is intact. Well, I'll start with the disappointments. Basically, since we're so concentrated, most of our money is in 5 to 8 ideas. You know, once in a while we blow it. And occasionally when we blow it, because we're concentrated, it hurts the fund a lot. Now, if that happens because we say, look, we're going to invest and there's a small chance this outcome occurs, and that occurs, we're okay with that. Because over a lifetime of investing, things that have a 10% chance of occurring will occur. What's really a mistake is if something that's off my radar, something I didn't think about at all, happens. And in 2002, we invested in a company called Adelphia, which was a cable company run by a very, very fraudulent criminal family called the Reguses, who are now in jail. And it was going through, it took a while for the frauds to come out and for the story to unfold. And we like stories like that typically because we can do the analysis and sometimes separate the asset value net of liabilities from the noise in the market. In that case, we did that. I did a lot of work on the assets themselves. I got very confident in what they were worth. And on the liability side, I took the liabilities as they were stated, but I did not account for correctly all the different liabilities that had not yet been disclosed. And this family had been running the company for 30 years or more. And in a situation where there's a fraud, and it's a fraud that's been going on by the same people for many decades, what I now know but didn't realize then is there can be levels of fraud that are very, very deep in the company. So no matter how far you look back in the financials, you never know where all the frauds are. And the company can do really crazy things. Like they did something totally crazy. And there was no way to see this, but if you had known they were criminals and really understood that, you probably would have realized there's more bad things to come. What they did was they set up a separate private partnership. They had the company loan money from the left side of the balance sheet, loan money to the private partnership. The private partnership bought the stock and bonds of the company in public offerings to support the price. So it created a circularity between the left and right side of the balance sheets. So as the company's stock and bonds dropped in value, the collateral of the loan dropped, so their assets were dropping too. And it's a crazy thing to do, but they did it. And what I should have I couldn't have figured out that that's what would happen, but I could have said, you know, these are bad people. They've been bad people for a long time, and there's probably a lot I don't know about the story, and I should have thought of that.
And your greatest success?
Oh, I don't know. I think, you know, what we try to do is we try to be humble and to get into situations where we feel we're very safe, even if a whole bunch of bad things happen, and enter at a price where we're very likely to get paid for putting capital at risk. Over my lifetime, Berkshire Hathaway is my greatest success because I first got interested in it in the 80s, and it's been a good run since the 80s for Berkshire Hathaway. For this fund, we've had a couple of interesting things that have worked out well. Occasionally things work out better than we expect, and that's always nice. Well, I was just speaking with Zeke Ashton, one of the other speakers, about this, and I think this was a fantastic conference. And what was really nice about it is it was one long day, but we got tons of interesting ideas. I mean, all the speakers I know have been saying in the off hours, like there's a lot of really interesting ideas people presented. And I thought all the speakers had interesting ideas, and some of them had ideas that appealed to people with different flavors of investing styles. So I think for a conference, that's perfect, because no matter what type of investment you like, if you're in the audience, one of the speakers probably spoke to that.